In this video, I'm going to explain an investment process that works for 99% of people. Whether you're a business owner, an upcoming entrepreneur, or anyone looking to improve their financial situation and get smarter with their money, this is for you. As a certified financial planner, I've seen firsthand how having a solid investment process can help maintain and grow wealth, especially when you unexpectedly come into a large sum of money. When you receive an inheritance, earn a large bonus, prepare for retirement, or sell your business, you're faced with the biggest question: what should I do with my money? Should I invest it all, keep it in cash, or do something else? Today, I'll help you answer these questions and explain why asset allocation is the most important investment decision you can make. So let's dive into exactly what is asset allocation and why is it essential for building and maintaining wealth. Asset allocation is the process of dividing your money among different types of investments like stocks, bonds, or real estate in specific proportions that align with your goals, needs, risk tolerance, and stage of life. So to break it down further, if you have a 401k or an investment account, you've probably seen a pie chart that shows you where your money is invested. It might look something like this. We have this pie chart. We have 50% in stocks. We have about 30% in bonds. Then maybe 15% is in real estate, and then the remaining 5% is usually in cash. So this is your asset allocation where your money is divided into various buckets, each with a specific percentage allocated to it. Spreading your money across different investments decreases your risk and increases your potential returns over time. And the best part is, it doesn't cost you anything. So think of the old saying, don't have all your eggs in one basket. Asset allocation prevents you from making the mistake of being over-concentrated in just one type of investment. Now, how do we determine how much to put into each bucket? Should you have 80% in stocks or 50%? Should we have 60% in bonds or 20%? The answer varies for everyone, but here's how you can figure it out for yourself. Think of your money in two separate investment buckets with different levels of risk and reward. The first bucket is your security bucket, your safe money. It won't grow very fast, but will have steady growth over time. It might even get boring, but it's secure. If you need it, it will be there. And the second bucket is your growth bucket. So this is more exciting because it offers the potential for faster growth, but it also comes with more risk. This bucket experiences more ups and downs in the short term, but tends to grow significantly over time, building long-term wealth. How much goes into each bucket depends on your time horizon and your risk tolerance. So ask yourself, how much risk can I afford to take at this stage in my life? If you're in your 20s and 30s or early 40s, you have time on your side and can afford to be more aggressive with your investments. If the market drops, you have more time to recover. But if you're in your late 40s, 50s, or 60s, you don't have as much time, so you might start to dial back on the growth investments. Another important question to ask is, what is the purpose of the money I'm investing? Saving for retirement is very different from saving to buy a house or a business in the next few years. If you don't plan to use the money in the next 10 plus years, you might invest it for growth. If you need it to access sooner, keeping it in a safe bucket would be a wiser decision. Now, I've worked with people in their 50s and 60s who are comfortable taking on more risk because market fluctuations don't stress them out. And that's okay. Allocate your investments in a way that lets you sleep at night when the market starts to get wild. Let's break down the specific investment options for the security and growth buckets. So first, in the security bucket, we have cash or cash equivalents, otherwise known as money market funds, currently offering attractive rates actually around 5%. Then we have CDs. Then we have pensions, which provide a lifetime income stream, though they're pretty rare these days. Next is fixed annuities, which can be effective but are often complex and come with fees. We have bonds, specifically TIPS, which are Treasury inflation protected securities. And then last, I'll add in term life insurance here, not to be seen as an investment, but if you have a family, kids, or other dependents, this makes sure they will be financially cared for if something happens to you. If you were to pass away, they could take the proceeds from the insurance and turn that into an income stream. Next, we have the growth bucket, which is starting with equities, where you can buy individual stocks or own hundreds of stocks through ETFs or mutual funds. Next, we have real estate, where you buy properties outright or invest in real estate investment trusts. Other options include high yield bonds, commodities, currencies, collectibles, and cryptocurrency. As you can see, the ways you can invest are endless, but it all comes down to three crucial points. Number one, determine an appropriate asset allocation for yourself to avoid panicking during market fluctuations. Understand the purpose of the money you are investing so you have access to it when needed. Consider your stage in life. Whether you're in your 20s or 50s, your goals and risk tolerance will likely be different. And having a plan and an appropriate asset allocation helps lay the foundation for becoming a successful long-term investor. So thank you all for listening. If you enjoyed this video, click that subscribe button and I will catch you on the next one.